Let's talk about something everyone wants to know. How to double your money. It sounds great, but how do you actually make it happen? That's where a simple and powerful financial concept called the Rule of 72 comes in. It's one of the easiest ways to understand how your money grows over time. This rule isn't just a neat trick. It's a valuable tool to help you plan for your future, whether you're aiming to build wealth, retire comfortably, or feel more secure about your finances. The Rule of 72 can give you a clear idea of how long it will take for your investments to double. In this guide, we'll break down how it works, show why compound interest is your best friend, and explain how applying this rule could transform your financial outlook. Ready to unlock the secrets of doubling your money? Let's dive in. By the way, if you're finding this video helpful and want more content like this, comment more below. Let's keep going. What is the Rule of 72? The Rule of 72 is an easy way to figure out how long it will take for your money to double, based on the interest rate you're earning. It's a quick mental shortcut that doesn't require complicated math. All you need to do is divide 72 by the annual interest rate as a whole number, and the result is the number of years it will take to double your investment. For example, if your investment earns a 6% annual return, you divide 72 by 6, which equals 12. This means it will take about 12 years for your money to double. It's a simple and flexible formula that works with nearly any rate of return, which is why it's so useful for planning your finances. What makes the Rule of 72 so reliable is that it's based on mathematical principles, specifically logarithms, that give an accurate estimate for typical growth rates. It's most effective when the interest rates are between 5% and 12%, which aligns with what most people can expect from long-term investments like stocks or mutual funds. Let's take another example. Say you have an investment earning 8% annually. Divide 72 by 8 and you get 9. This means your money will double every 9 years. If you keep the investment for 18 years at the same rate, your money doubles not just once, but twice. That's the power of compounding. It multiplies your wealth over time without you having to do anything extra. The Rule of 72 is simple yet powerful, making it a great tool to understand how your investments can grow and to stay motivated as you work toward your financial goals. The power of compound interest. The Rule of 72 helps you estimate how long it will take for your money to double, but compound interest explains how it grows so quickly. Think of compound interest as interest on interest. When you earn interest, it's added to your original amount, called the principal, and then you start earning interest on this larger total. This process creates a snowball effect, where your money grows faster over time. Here's an example. Imagine you have $1,000 in a savings account earning 5% interest per year. At the end of the first year, you'll earn $50 in interest, bringing your total to $1,050. Now, in the second year, you're not just earning 5% on the original $1,000. You're earning it on $1,050. That means you'll earn slightly more interest in the second year. Each year, as the balance grows, so does the amount of interest you earn. Over time, this compounding effect accelerates, helping your money grow much faster than it would with simple interest. This is the true power of compounding. It's your money working harder for you as time goes on. Now let me make it more personal with my own story. A few years ago, I decided to put $2,000 into a high-yield savings account offering a 6% annual interest rate. At first, I wasn't expecting much, but I wanted to see how compounding would work for me. In the first year, I earned 6% interest on my $2,000, which added $120. My total balance grew to $2,120. In the second year, I earned 6% not just on the original $2,000, but on the $2,120. This time, the interest added up to $127.20, bringing my total to $2,247.20. By the third year, the compounding effect became even more obvious. Now 6% on $2,247.20 earned me $134.83. My balance grew to $2,382.03. Fast forward 10 years, and without adding a single extra penny of my own money, my account had grown to over $3,579. That's $1,579 of growth, just because I let my money sit and compound. Think of compound interest like planting a tree. At first, it's just a small seed and the growth is slow, but as time goes on, the roots, your principal, grow stronger, and the tree, your total balance, grows taller, producing more fruit, interest every year. The key is patience. The longer you let compounding work, the more powerful it becomes. This is why starting early is so important. Even small amounts invested today can grow into something big over time. Compound interest isn't just a financial formula. It's a tool that turns time into your greatest ally for building wealth. How to use the Rule of 72. Let's look at how the Rule of 72 can work in practical situations to help grow your money over time. For example, imagine you have $5,000 saved up for your child's future education in an account that earns 4% interest. According to the Rule of 72, your money will double every 18 years. So in 18 years, your $5,000 will grow to $10,000. After another 18 years, that $10,000 will double again to $20,000. In just 36 years, your initial $5,000 will have turned into $20,000. Now let's consider planning for retirement. Suppose you invest $25,000 in a growth fund with an average return of 7% per year. Using the Rule of 72, your money will double every 10.3 years. After the first 10 years, your $25,000 will grow to about $50,000. After 20 years, that $50,000 will grow to around $100,000. And in 30 years, your $100,000 will double again to $200,000. These examples show how powerful compounding can be. By letting your money grow over time without making additional contributions, you can achieve significant growth. The longer you leave your money to compound, the more it works for you. The impact of interest rates. Let's look at how interest rates can really impact your money. While we've talked about returns, understanding interest rates is key to seeing how quickly your money can grow. The Rule of 72 helps us figure out how long it will take for your money to double at different interest rates. For example, if you earn a 4% interest rate, it would take 18 years for your money to double. But if your interest rate is 8%, your money would double in just 9 years. That's a significant difference. The higher the interest rate, the faster your money grows, which is why it's important to seek out investments that offer good returns. Once you start understanding this, you'll see how even small changes in interest rates can make a big difference. A 1% or 2% increase might not seem like much at first, but over time, it can really change things. For instance, at 4%, your money doubles every 18 years, but at 6%, it doubles every 12 years. That small difference means a lot in the long run, showing how critical it is to pay attention to the interest rate when choosing where to invest your money. Finding investments with high returns might feel overwhelming, but there are plenty of options out there, and it's about choosing what works best for your financial goals. A common choice for those looking for higher returns is investing in stocks or funds that follow major indexes like the S&P 500. Historically, the S&P 500 has averaged around 10% annual returns. Using the Rule of 72, this means that your investment will double roughly every 7 years. Of course, stocks come with their share of risks. The market can go up and down, and prices can fluctuate. However, if you have a long-term outlook and don't panic during market downturns, stocks have the potential for substantial growth over the years. This is why many investors look to stocks for building wealth over the long haul. If you're someone who prefers a safer investment with more stability, there are options like bonds. Bonds generally offer more modest returns, usually around 4% to 5%. While the growth is slower compared to stocks, bonds still offer compounding interest, meaning your money grows over time. The doubling time for bonds is longer, around 14 to 18 years, but they can provide more consistency and lower risk for investors who are uncomfortable with the volatility of the stock market. The key to choosing the right investment is understanding your own risk tolerance and financial goals. Are you willing to take on more risk for the chance of higher returns? Or would you prefer a steadier, lower risk path to growing your wealth? By determining the level of risk you're comfortable with, you can make better decisions about where to invest your money and how it will grow over time. Additionally, remember that diversifying your portfolio, splitting your investments between stocks, bonds, and other assets can help balance risk and reward. Inflation, the hidden opponent. While we focus on growing our money, we also need to be aware of inflation, which can quietly eat away at our purchasing power. Inflation is like the opposite of compound interest. It reduces the value of money over time. When inflation is at 3%, prices for goods and services double every 24 years. This means that even if your money doubles, its value might not be as high as you expect when you compare it to today's prices. For example, if inflation is higher than the return on your investments, your money is losing value. Let's say your investment grows by 2% per year, but inflation is 3%. Even though your money is technically increasing, you're losing purchasing power because things are getting more expensive faster than your money is growing. On the other hand, if your investment grows at a rate of 6%, you're not just doubling your money over time, you're also staying ahead of inflation. This means your money is not only growing but also maintaining its purchasing power. To protect your wealth, it's important to aim for returns that outpace inflation so that your money retains its value as time goes on. Real-world challenges. While the rule of 72 is a useful way to estimate how long it will take for your money to double, it's important to remember that it's just an approximation, not an exact science. The real-world returns on your investments can fluctuate, and there are always risks to consider. For example, if the stock market goes through a rough period, or if you face unexpected financial challenges like medical bills or home repairs, your progress toward doubling your money could be delayed. These types of uncertainties are part of investing, and the rule of 72 can account for them. Another important factor to keep in mind is the impact of taxes and fees. Let's say you invest in a fund that promises an 8% return per year. On the surface, that seems like a great deal. Your money is growing steadily. However, if you lose 2% of your return to management fees or taxes, your effective rate of return is only 6%. This means the time it takes for your money to double is much longer than initially estimated by the rule of 72. Here's the example. Imagine you invest $10,000 in a mutual fund with an 8% annual return. Using the rule of 72, we expect your money to double in 9 years, 72 divided by 8. However, if 2% of that return is taken up by fees and taxes, your actual return is only 6%. With a 6% return, it would take about 12 years for your investment to double instead of the 9 years you'd expect at an 8% return. So when you're evaluating potential investments, it's crucial to look beyond the advertised return rate and consider the net return you will actually receive after fees and taxes. By doing this, you can get a more accurate picture of how long it will take for your money to grow and make better decisions about where to invest. Long-term growth and financial freedom. When you think about your future, whether it's 10, 20, or 30 years from now, it's important to realize that every dollar you invest today has the potential to grow significantly over time. The rule of 72 isn't just a formula, it's a way of understanding how your money can multiply as time goes on. With each time your investment doubles, you're getting closer to achieving financial freedom. It's a process that rewards patience. Your money grows steadily year after year. It doesn't matter if you're starting with $500 or $50,000. The path to wealth is the same. Steady, long-term growth driven by compounding interest. By using the rule of 72, you can see how your money could double and keep growing as long as you invest for the long term and let compounding work its magic. With time, the right interest rate, and a bit of patience, you'll be on your way to a more secure and wealthier future. This isn't just a concept from math. It's the real power of compounding that helps turn small, consistent investments into significant wealth. If you enjoyed this video, give it a thumbs up and share your thoughts in the comments. For more informative content on finance, entrepreneurship, and self-improvement, subscribe to our channel. We post new videos every other day to help you succeed in various aspects of life. Have a great day and see you in the next one.